Welcome to The Explainer. Today, we're taking something that honestly looks like absolute chaos. The jagged, totally unpredictable lines of a trading chart, and we're going to turn it into a clear, readable map. If you've ever looked at a market chart and felt like you were trying to read some completely foreign language, well, this explainer is going to be an absolute game changer for you. We are unpacking 18 essential trading patterns that signal exactly where the market is heading next. And here's the absolute best part. It's something I like to call the evil twin concept. See, almost every pattern has an exact inverse counterpart, which means learning these 18 patterns is literally going to be twice as easy.
So, here's our roadmap. We'll start with a quick intro to chart patterns, move into major reversals, look at breakouts and continuations, explore the slow shifts of wedges and curves, and finally wrap it all up with some essential trading strategy rules. All right, let's jump right into Section 1, Intro to Chart Patterns, and figure out how to find some order in all that chaos.
To really get started, we need to clarify what we're actually looking at here. You might already be familiar with candlestick patterns, right? Those usually rely on just one or two individual candles to tell a super short-term story. But a true chart pattern is a whole different beast. It's a much larger formation created by many candles over a longer period of time, and it paints a picture of a much broader bullish or bearish trend. Throughout this explainer, we're going to anchor all of these patterns using two critical lines that are driven entirely by human psychology. First up is support. Think of this as the floor. It's where buyers eagerly step in because they think the price is an absolute steal. And second is resistance, which is the ceiling. That's where sellers start to panic, take their profits, and push the price right back down.
And that brings us perfectly to Section 2, Major Reversals. We're looking at exactly what happens when the current trend flips completely on its head.
Okay, let's look at what is arguably the most famous formation out there, the head and shoulders pattern. Now, this is a bearish signal forming in an uptrend. The market creates a high point. That's the left shoulder. Then it drops, rallies to an even higher point, the head, drops again, and rallies to a lower high, the right shoulder. The crucial support line connecting the bottom of these moves is what we call the neckline. And when the price breaks down through that neckline, it signals a massive drop. But here is the really fascinating part. The inverse head and shoulders is the exact same pattern, just flipped totally upside down. It forms in a downtrend, and when the price breaks upward through that resistance neckline, boom, it signals a major bullish rise. You learn one, and you automatically know it's twin.
Moving on, we've got these highly recognizable M and W-shaped patterns. A double top basically acts like a rock-hard ceiling. The price hits resistance twice, totally exhausts its upward momentum, and falls. Classic bearish signal. Its bullish twin, the double bottom, does the exact opposite. The price hits a support floor twice, forming this nice W shape before springing right back upward. These pop up incredibly frequently in charts, which makes them fantastic opportunities once you actually train your eye to spot them.
So, the natural question is, what happens if the market tests those exact levels a third time? Well, you get a triple top or a triple bottom. Because the market has tried and failed to break the resistance or support line 3 separate times, the buildup of pressure there is just immense. It's kind of like a dam holding back water, right? The more times it's tested, the harder it finally breaks. When that neckline eventually gives way, the resulting move is significantly stronger and way more reliable than what you'd see with their double top or double bottom siblings.
All right, let's transition into Section 3. Because instead of reversing, what if the market just needs to catch its breath? Let's talk breakouts and continuations.
Very often, right after a seriously strong move, the market enters this simple consolidation phase, creating a rectangle. A bullish rectangle is honestly just a resting phase in an uptrend. It's bouncing sideways between a flat ceiling and a flat floor. It's really just taking a breather. Once it finally breaks out above that resistance, the rally continues. Conversely, the bearish version pauses during a downtrend before inevitably breaking downward to continue the fall.
But sometimes that resting phase gets totally squeezed. Take the ascending triangle, for example. Notice how the resistance line stays totally flat, but the support line just keeps rising? Buyers are getting impatient. They're stepping in earlier and earlier, pushing the price up into that flat ceiling until it inevitably just shatters upward. It is a highly bullish continuation. And this brilliantly illustrates its twin, the descending triangle. Here, the support floor is flat, but sellers keep pushing the resistance lower and lower until the floor gives out, resulting in a really sharp bearish drop.
Let's move over to pennants and see how this builds on that whole triangle concept. A pennant forms after a massive, steep price movement, which we call the pull. After that sharp pull, the support and resistance lines tightly converge into this tiny little triangle. It's a very brief, super aggressive pause. A bullish pennant is going to shatter upward to continue the massive rally,
while its bearish counterpart breaks downward, extending a massive crash.
Moving right along to Section 4, Wedges and Curves. Because market shifts aren't always sharp, sometimes they're slow, deceptive, and they'll catch you completely off guard.
Okay, pay super close attention here, because these patterns are absolute visual traps. The rising wedge looks like a perfectly healthy uptrend because both the support and resistance lines are heading up. But do you see how they're squeezing together? The buyers are actually losing momentum behind the scenes, making this a bearish trap that eventually breaks down. Its evil twin is the falling wedge. It looks like a gloomy downtrend, but the selling pressure is actually drawing up in that tight squeeze, hiding a massive bullish breakout to the upside.
Next up, we have the rounding top and rounding bottom, and there are literally no sharp angles here at all. The market just slowly loses its prior momentum, drifts completely sideways, and then gradually reverses course. It forms this slow, sweeping U-shape. Now, these patterns require a lot of patience from a trader, but once that gradual curve completes and finally breaks the neckline, the new trend is usually incredibly solid.
But this actually raises a really fascinating question. What happens when the market takes one of these slow, curved U-turns, building up all that momentum over time, only to get firmly rejected at the resistance line at the very last second?
Well, the answer is our most complex, yet seriously reliable pattern pair, the cup and handle. We see that slow, bullish U-shape form the cup, but then it gets rejected at the neckline. That little dip, that's the handle. It's basically a final shakeout of impatient traders. Bouncing out of that handle and breaking the neckline provides an exceptionally strong bullish signal. And, just as you'd probably expect by now, the inverted cup and handle does the exact same thing in reverse, providing a highly reliable bearish drop after that small handle bounce fails.
Wow. Okay, we've covered a ton of ground, which brings us to our final and absolutely most crucial section, trading strategy rules. Let's put this into practice. Because, let's be real, knowing all 18 of these patterns is completely useless without a strict, repeatable system to actually trade them. Across all the source material we analyzed, the strategy really boils down to this actionable 4-step formula. Step 1, draw your support and resistance lines and be accurate about it. Step 2, patience. This is crucial. You must wait for a candle to not just break the line, but actually close outside of it to confirm the real breakout. Step 3, risk management. Set your stop loss just below the breakout candle for a bullish move or just above it for a bearish move. And step 4, set your profit target. A highly reliable rule of thumb here is to measure the height of the pattern itself, like, say, the distance between the rectangle lines or the length of a pennant's pole, and project that exact same distance outward from your breakout point.
And here it is, your ultimate cheat sheet. Just marvel at this for a second. We took what looked like total market chaos and neatly organized 18 distinct formations into 2 simple columns, bullish signals and bearish signals. By really grasping that twin concept, you aren't memorizing 18 random shapes, you are simply learning 9 core psychological market shifts and understanding exactly how they play out in both directions. It just instantly declutters the whole chart.
So I'm going to leave you with this thought. Every single day, millions of people look at market charts and see nothing but random, terrifying spikes and drops. But now you have the playbook. Will you let the chaos control your decisions, or will you use these 18 patterns to finally decode the market's hidden language? The next time you pull up a chart, apply what you learned in this explainer. Look for the shapes, draw your lines, and just watch the story unfold. Thanks so much for joining me on the explainer, and keep learning.